Fundamental analysis is a crucial process in the world of investing. It involves a thorough examination of a company's financial statements to determine whether its stock is a wise investment. These financial statements include the balance sheet, income statement, and cash flow statement. By dissecting these documents, investors can gain insight into the financial health and stability of the company, helping them make informed investment decisions. In this comprehensive guide, we will explore how fundamental analysis uses these statements to evaluate a company and make sense of its financial standing. The balance sheet. Let's begin by delving into the balance sheet, which is a critical component of fundamental analysis. The balance sheet provides a snapshot of a company's financial position at a specific point in time by comparing its current assets to its liabilities and owner's equity. To understand this better, let's define these terms. Assets. Assets are the valuable items that a company owns. These can include cash, equipment, property, and investments. In essence, assets represent the resources that the company can use to generate revenue and fund its operations. Liabilities. Liabilities, on the other hand, represent the company's financial obligations, typically in the form of debts or accounts payable. Each liability on the balance sheet often corresponds to an asset that helps balance the financial equation. For example, if a company takes out a loan to purchase a property, the loan becomes a liability, and the property serves as an asset. Owner's equity. Owner's equity, also known as capital, represents the portion of the company's assets that have been raised through the issuance of stock. When a company issues stock, whether in an initial public offering or a secondary offering, it raises capital that can be used to cover various business expenses and investments. Achieving balance. A fundamental principle of the balance sheet is that it must balance. This means that the total value of the company's assets should be equal to the sum of its liabilities and owner's equity. This balance is crucial because it offers insights into how a company raises its funds for its assets and whether it is overextended financially. The income statement. While the balance sheet provides a snapshot of a company's financial position, the income statement sheds light on its revenue, expenses, and profitability. It provides a dynamic view of the company's financial performance over a specific period, often quarterly or annually. Revenues and expenses. The income statement details a company's revenues, which are the earnings generated through its primary business operations. These revenues are then offset by expenses, which encompasses all the costs associated with running the business, such as operational expenses, interest paid on loans, and taxes. Net income. The bottom line of the income statement is the net income, which represents the company's earnings. Net income is a crucial metric for investors, as it reflects the profitability of the company after all expenses have been deducted. How a company handles its earnings can vary. It typically involves one of two approaches. Number one, dividends. The company may choose to distribute a portion of its earnings to shareholders in the form of dividends, providing investors with a direct return on their investment. Number two, reinvestment. Alternatively, a company may reinvest its earnings back into the business. This can help improve the company's cash position and fund growth initiatives. The cash flow statement. A strong cash position is often seen as a sign of financial stability and resilience, making it a vital aspect of fundamental analysis. The cash flow statement provides a detailed account of how a company uses its cash for day-to-day operations and investments, as well as how much is borrowed from banks or bondholders. Operating, investing, and financing activities. The cash flow statement typically categorizes cash flows into three main activities. Number one, operating activities. These include the cash flows generated or used by the company's core operations. It encompasses revenue, expenses, and changes in working capital. Number two, investing activities. This category covers cash flows related to the purchase or sale of assets, investments in other companies, and capital expenditures. Number three, financing activities. Financing activities involve cash flows from borrowing or repaying debt, issuing or buying back shares, and paying dividends. By examining these cash flows, investors can gain a deeper understanding of how the company generates revenue and manages its finances. Importantly, The cash flow statement is considered less susceptible to manipulation than the income statement, making it a reliable source of financial insights. The significance of ratios. As you can see, fundamental analysis involves sifting through a wealth of information contained in financial statements. To make this process more manageable and insightful, investors often return to financial ratios. These ratios provide a structured way to compare stock and assess their financial wealth. One of the most commonly used ratios is the price-to-earnings ratio, the PE ratio. The PE ratio helps investors look beyond a stock's price and gauge its value relative to the company's earnings. Calculating the PE ratio involves two steps. Number 1, earnings per share. First, you divide the company's net income or earnings by the number of outstanding shares. This figure is known as earnings per share. Number 2, PE ratio. Next, you divide the stock's price by its EPS to obtain the PE ratio. To illustrate this with an example, consider 3 stocks with varying share prices. Number 1, stock A is trading $6 per share with an EPS of $0.20, resulting in a PE ratio of 30. Number 2, stock B is trading at $35 per share, boasting an EPS of $1.40, resulting in a PE ratio of 25. Number 3, stock C is priced at $132 per share and has an EPS of $3.90, resulting in a PE ratio of 34. Despite the significant differences in stock prices, all 3 companies exhibit a similar valuation when assessed through their PE ratios. In this case, stock B, with the lowest PE ratio, may appear to be the best value. Exploring other ratios. It's important to note that the PE ratio is just one of the many ratios available for evaluating stocks. Investors can use various ratios to assess different aspects of a company's financial health, including valuation, profitability, and financial strength. Moreover, there are numerous other financial metrics and figures within the financial statements that provide valuable insights into a company's performance and prospects. In conclusion, fundamental analysis is an indispensable tool for investors seeking to make informed decisions about stock investments. By closely examining a company's balance sheet, income statement, and cash flow statement, as well as employing financial ratios, investors can gain a comprehensive understanding of a company's financial health and potential. While we've only scratched the surface of fundamental analysis in this guide, it's crucial to continue learning and expanding your knowledge in this area before making investment decisions. Remember, fundamental analysis is a powerful tool, but its effectiveness relies on a thorough understanding of financial statements and the broader economic landscape. With the right knowledge and analysis, you can navigate the world of investments with confidence and make well-informed choices to achieve your financial goals.